Hi, my name is Bruce Dweck with Keller Williams Realty, and I'm here today to share with you information on the best way to get pre-qualified for a loan. And today I have with me Shea Peck with Bank of England Mortgage, who is an expert in this area, has been in the business for many years, and we can talk to you about getting pre-qualified. The two things that are critical in getting pre-qualified are debt to income ratio and credit score. We're going to cover the first one today. Shay, why don't you tell us what's important about this and what we need to know?
Absolutely. So your debt to income ratio is one of the important factors on whether you're qualified for a certain amount or for a loan. So when we look at that, we're looking at your gross monthly income. So we are looking at it prior to the taxes and everything like that, gross monthly income and your monthly debt. So we'll say if you have $10,000 student loan, but you pay $100 on it a month, we're counting that $100 factored against you with your monthly income versus the total amount of debt. So we're comparing the monthly debts versus the monthly incomes together. So that's really what's defining the debt to income ratio. Why it's important is because we want to make sure that you're not overextending yourself as far as your home payment compared to everything else that you've got to pay as well. Some things to keep in mind that we actually don't factor into it are things such as your phone bill, cable, electric. There are a lot of things that we don't look at if it's not on the actual credit report, such as your car payment or a student loan or a credit card. We're not factoring that in. So I do always remind my borrowers, especially first-time home buyers that haven't had such a payment with all the utilities and everything combined, you've really got to be careful because you'll have all those things to pay for too each month. So what's most important in the debt to income factor is there are different caps per each program. However, as long as we like to stay in the 30s would be a good range to be in. That's a normal range for people. Between the 20s to 30s, that's a safe place to be. When you get up into the 40% of debt to income ratio, things start to get a little more tight and you got to worry a little bit more when you creep up to that 50 mark if, you're able to even go forward.
Right. So it's important that people realize that they manage their own debts coming into buying a home because you as a lender, you're going to look at that critically in order to lend them the money to buy the house.
Absolutely. And then they've got to remember all the other little debts that we aren't taking into account that they have to make sure that they're comfortable with paying too.
Right. And I've also heard that it's also a good idea not to, make a major purchase when you're getting ready to buy a house because this will adversely affect your debt to income or even your credit score as well. Is that correct?
Correct. So anytime you have someone pull a credit report on you, if it's a hard hit, that bureau will report, so we will see it. In addition to that, people that do that right before they're being pre-qualified for a house or during the process, if we don't see it on your initial credit report and you don't disclose that debt to us, and then we do a soft pull 10 days before closing, and boom, all of a sudden you have a car payment that didn't exist before. We were qualifying you based off of the debts we saw on the credit report. And if we don't know that debt exists, then yeah, that's why we try to avoid doing anything around the same time as the pre-qualification.
That makes a lot of sense. Now you mentioned soft pull and hard pull. What are the differences on those things?
So a hard pull actually goes and hits your credit. It shows as an inquiry on your credit report that typically stays for 120 days. A soft pull is more or less just an update to see when we do a soft pull right before closing, we just make sure that, someone hasn't added thousands more onto their revolving credit card or that they haven't gone out and purchased a new car or something like that. But we can also soft pull scores just to see if those scores have changed, and if they have increased or something that would be beneficial to the loan, then we can always hard pull on that and use that credit report moving forward.
Okay, great. Well, thank you very much for that. It was very informative. I would just encourage anybody who has additional questions to get in touch with Shay. And if you're ready to start shopping, you can get in touch with me. You can use my mobile search app, and that information will be on our final slide. So thank you very much today.
Thank you.